With the prospect of the first interest rate cut in 4 years coming, some investors and financial advisors are preparing. On today's show, we'll examine ETF strategies for navigating changes to interest rates, plus getting more dividend income, along with solutions for limiting the bite of taxes. Paul Baiocchi with SS&C ALPS Advisors joins us right after this. Stick around. Welcome to the program. I'm Ron DeLegge. It's great to see you again. If you enjoy our original series shows like this one, please hit the like button and be sure to subscribe. We also enjoy seeing questions and thoughts in our YouTube comment section below, so don't be a stranger. Finally, you can also watch ETF Guide TV on all major streaming platforms, including Apple TV, Amazon Fire TV, as well as Roku. We're pleased to have with us Paul Baiocchi with SS&C ALPS Advisors joining us. Paul, thank you for being here. Welcome back.
Great to see you, Ron. Thanks for having me.
Let's start out talking about small cap stocks. We've got OUSM, that's the O Shares US Small Cap Quality Dividend ETF. And this particular one has delivered impressive results. Over the past year, OUSM has outperformed small cap ETF peers linked to the Russell 2000 and the S&P Small Cap 600. So how does OUSM work and what's contributed to its strong returns?
Well, first and foremost, what OUSM does is exactly what the name says it's going to do. It picks a portfolio of high quality dividend paying stocks in that small and mid cap universe. But the way that it goes about it is really through three angles. So the first angle is the quality characteristics. So it screens for high ROA, return on assets, low net debt to EBITDA, so low leverage. And then on the dividend side, it focuses on companies that pay dividends, grow their dividends, and have well-covered dividends. And the third piece is a low volatility screen. So the idea is you're taking this universe fraught with risk, fraught with companies that are either unprofitable, have high leverage levels, don't pay dividends, don't grow their dividends, and you're culling that universe down to a more manageable list of names defined by quality characteristics that generate strong profitability on their asset base without excess leverage, and at the same time are using that profitability profile to pay dividends, grow their dividends, and ensures that the dividends that they are paying are well supported and well covered by fundamentals and by their earnings profile. And so it's one of our favorite products to talk about, largely because you look at the Russell 2000 divided by the S&P 500, we're at levels we haven't seen going all the way back to the dot-com era. And historically, when you get to the end of a Fed rate hiking cycle and begin an easing cycle, it's typically when you get strong relative performance from small caps. But importantly, some of the economic dynamics that have punished small caps over the course of this most recent market cycle are unlikely to just fade away because we got 50 basis points, 75 basis points, or 100 basis points in rate cuts from the Fed. And so it's still important, paramount, if you will, to focus on companies in this universe that don't have a lot of those problems that you get when investing in the Russell 2000 or the S&P 600. You're effectively taking that universe of stocks and just separating out the companies that have quality characteristics and durable dividend characteristics.
Yeah, great points and a good time to be looking at small caps, of course, with a selective approach. Shifting gears, some investors in index-linked REIT funds might not be happy with what they're seeing. Not only have REITs been lagging performers over the past few years, but the real estate market is a lot more complicated today due to dramatically higher interest rates compared to just a few years ago. A fresh approach with an active hand is how the ALPS Active REIT ETF, ticker REIT, is invested. Tell us more about the fund and who might it appeal to.
Yeah, so the fund itself is really interesting because it's an actively managed REIT strategy run by a team, GSI, which was spun out of Green Street, which is one of the most widely followed institutional real estate research firms on Wall Street. And effectively, they have the flexibility through their active mandate to pick and choose among individual REITs, as well as pick and choose among individual industry groups within the REIT complex. And I would say, Ron, there's a couple different categories of investors who we're targeting with REIT. The first is the folks who have been in private real estate funds, have seen sort of gating at some of their private REIT strategies, or looking to move out of those private REIT strategies and see the public REIT category as on a relative valuation basis or otherwise potentially an attractive alternative to the private category. The other investors who we're targeting are folks who have been just invested, as you mentioned, in the index, whether that's a broad-based REIT index or just an ETF that tracks a specific index. And ultimately, the team at GSI has this really long track record, this expertise, this experience in managing, researching, and diving into the fundamentals that drive profitability and relative performance in the REIT space. And so what we believe REIT can do is offer investors who want to be in the public REIT space a compelling alternative to the benchmark, which is where the bulk of ETF assets still sit to this day, and also allow them, as the fund has produced really strong relative performance over the course of the past 3 years since inception, the flexibility of a REIT strategy being actively managed by a firm that has that type of expertise and experience in this marketplace. So moving out of private real estate and moving off of the benchmark is really what we're trying to communicate to advisors investing on behalf of investors who allocate to REITs as part of a strategic asset allocation framework.
Yeah, makes sense. Now, coming off the aftermath of aggressive rate hikes, we could be entering a new phase of interest rate cuts beginning in the fall. How will this potentially impact bond ETFs like the ALPS Smith Core Plus Bond ETF, that's ticker symbol SMTH?
In some ways, it's comparable to what we just talked about with REITs, in the sense that there are a lot of advisors and investors who, part of a model portfolio framework or otherwise, just default to the ag. And we think the ag is problematic. Duration has inched higher and higher over time in the aggregate bond index that most people watch and that a lot of passive ETFs follow. But also, we think that this is not just a challenging fixed income market now, but it's going to continue to be extremely challenging, 50 basis point rate cuts or otherwise. And what you need is someone who has experience managing through all types of fixed income market cycles. And with SMTH, you get access to Gibson Smith and his team at SCI. And what Gibson has done is experienced all of those various market cycles, increasing interest rate environments, decreasing interest rate environments, steepening yield curves, flattening yield curves, inverted yield curves. He's been in the market for more than 30 years. And so being able to access a boutique fixed income shop ran by a guy, Gibson Smith, who has this extensive library of experience to pull from as he manages through what we expect to be a tumultuous fixed income environment on a go-forward basis, is really what we believe sets SMTH apart. Importantly, Ron, when you think about fixed income, it should be a ballast in your portfolio, in your asset allocation strategy against a backdrop of equity market volatility and uncertainty. And the way that the team at Smith manages their strategy, SMTH and the corresponding mutual fund SMTHX, is as that ballast in your asset allocation, a conservative old school bond shop that takes their outlook and applies it through their duration management, through their various industry exposures, through their various sector exposures. And importantly, what really sets them apart is the fact that they do that sort of old world, old school, bottom up fundamental research on individual credits. And so right now we're at a period where credit spreads, both in investment grade and high yield, are extremely narrow, extremely tight, historically so. And as such, they've sort of put together a shopping list of opportunities when and if credit spreads do widen back out. And so the ability to be flexible, the ability to be nimble, unlike some of these large behemoth fixed income shops, really sets SCI apart in this category that we think is critical to successful asset allocation strategies long term.
So municipal bonds are another area of the bond market that have been sought after for their tax-exempt income, and that's an arena where the ALPS Intermediate Municipal Bond ETF, ticker symbol MNBD, is focused. So how might advisors and investors deploy a fund like MNBD inside a diversified portfolio?
Well, it might sound like a broken record here, Ron, but this is another example of an active product at ALPS where we've gone and partnered with an advisor, a fixed income manager, a portfolio manager who we believe is best in class. Brown Brothers Harriman is a firm that's been around forever, one of the most widely regarded and well-respected firms on Wall Street. And certainly if you're in the muni bond market, you know Brown Brothers Harriman. And they're managing this strategy as they've managed private trust money for decades. And ultimately, it's a way that advisors and investors can get access to a category that is one of the most diverse, one of the broadest segments of fixed income in the market, and capture some of the expertise that they have in this specific segment of the marketplace. Muni bonds are typically somewhere rich investors go to, as you mentioned, get exposure to some tax exemptions. But importantly, they often gravitate toward single issue strategies specific to their own state. This is a national strategy, but it's a national strategy that's very much run in a conservative way, that's designed to give you risk-adjusted outperformance of its benchmark over long periods of time. And importantly, the muni bond market is so complex, so diverse, and having this long track record, this deep pool of expertise to go in and pick and choose individual issues within this marketplace and have the patience to go and invest in certain segments of the market that other investors, other managers might not even touch, is part of what makes the strategy so compelling in our eyes for investors and advisors operating on their behalf to allocate to muni bonds in the ETF wrapper.
One final question before you take off, Paul. The Alerian MLP ETF, that's ticker AMLP, along with the Alerian Energy Infrastructure ETF, that's ticker symbol ENFR, have both outperformed the S&P 500 energy sector thus far this year. And for income investors, both ETFs also offer very attractive yields. So tell us more about these two ETFs.
Yeah, Ron, we've done enough of these, and you know as well as anybody how much we love AMLP and the energy infrastructure space. So that includes ENFR, of course. And you're right, it has outperformed the broader energy sector. It outperformed the broader energy sector in calendar year 2023. And ultimately, this is a portfolio in the case of AMLP and more broadly in the case of ENFR, of companies who operate pipelines, storage, and processing facilities for crude oil and natural gas in the United States. And that business, which is oriented towards fees based on volumes for transporting, storage, and processing crude oil and natural gas, is a very stable business in the sense that it isn't as beholden to swings in the price of crude oil, swings in the price of natural gas, because it isn't a spread business. It's that fee-based business for providing those services. And as the United States continues to be at record levels of production for crude oil and for natural gas, and being a world leader in the production of both means that the pipelines, the storage, the processing facilities that help connect that production to consumption, both domestically and increasingly globally, are and have been very consistent businesses. So when you look at the profitability profile of these companies, you look at the fundamental profile of these companies, and you look at the overall operating environment of these companies, this is a very compelling segment of energy because you have valuations, enterprise value to EBITDA, that remain extremely subdued relative to where they've been historically. You've got a fundamental backdrop of companies that have increased their free cash flow, deleveraged, increased their distributions and dividends over the course of the past 5 years, and also have been enjoying the fruits of this growing energy production footprint in the United States. And as we continue to increase our capacity to export LNG abroad to Europe and to Asia, as we've seen natural gas liquid exports grow, so think about propane and ethane specifically, these are business lines that energy infrastructure companies are not only involved in, but are generating really strong profitability from. And so when we think about energy infrastructure, we think about it as a way to play the energy space in a very different way than the broader energy sector. We also think about it as a way, as you mentioned, to generate income from the equity sleeve of your investment allocation. And historically, this has been a category within the equity market that has generated really strong relative yields. So yields backed by strong fundamentals with a really compelling operating environment paired with valuations that have remained very consistent. So you talk about the outperformance of the S&P 500 so far this year. We talked about the outperformance of the energy sector over the course of the past couple years. And importantly, that performance has not been on the back of multiple expansion. In fact, the enterprise value to EBITDA multiples, the free cash flow yields on these companies have remained remarkably consistent over the course of the past 3 years, despite the fact that you've gotten strong compounded total returns from these companies over the course of that period of time.
Paul, thank you for dropping by and for your timely insights. Keep up the good work.
Always a pleasure, Ron.
Be sure to visit alpsfunds.com to learn more about the ETF lineup at SS&C ALPS Advisors. Hit us up below in the comments section. We'd love to hear from you. I'm Ron DeLegge with ETF Guide TV. Thanks for watching. We'll see you soon.